You know me. I'm usually chasing moonshots. Like, if there's a biotech stock that doubled last quarter, odds are I bought it way too late and sold it way too early. But with Section 899 now making headlines and markets reacting to the new rules, I'm actually wondering, does dividend investing still make sense?
For me, more than ever. Section 899 is this new legislation that could hit foreign investors with up to a 20% withholding tax on U.S. dividends and interest. It's aimed at countries taxing U.S. companies unfairly. Doesn't hit us directly as U.S. citizens, but it could spook international capital.
So, more volatility?
Exactly. And when things get jumpy, I want something that keeps paying me regardless of headlines. That's why I stick with strong dividend payers.
You and your steady cash flow. I'm over here trying to hit triples, and you're like, I'll take a monthly check, thanks.
Monthly checks that grow. That's the key. I'm not just trying to preserve capital. I want to build income I can rely on.
Okay, fine. Hit me with your top picks then. Just don't expect me to give up my spicy growth stocks.
Deal. I'll show you 3 that I think anyone, even risk junkies like you, could hold all the way to 2035. Think of it as my forever dividend portfolio. First up is S&P Global. You know how they run the credit ratings agencies? That's just one piece. They also own S&P Dow Jones Indices. Yeah, the people behind the S&P 500. And they provide all kinds of financial analytics, market intelligence, and risk assessments.
Ratings, indexes, data. I know it's important, but this is not exactly the stuff that lights up a stock chart.
Sure, it's not flashy, but it's foundational. This company is like the plumbing of global finance. Anytime someone issues a bond, builds an ETF, or wants to understand credit risk, there's a good chance S&P is involved.
So they're like the quiet kid everyone depends on during finals.
Exactly. Their free cash flow hit about $5.6 billion over the past year, a 56% jump from 2023. They've raised dividends for 51 consecutive years and plan to return 85% of that free cash flow to shareholders through dividends and buybacks. That puts them in the Dividend King Club, one of only 50 or so U.S. companies that can say that.
Okay, that's impressive, but the yield is low, right?
Yeah, under 1%, but it's rock solid. This is the kind of stock that helps your portfolio sleep through storms. And their payout ratio is around 30%, which gives them plenty of room to grow.
I don't hate that. I mean, I'd still rather see something go up 50% overnight, but I guess this is where grown-up investing starts.
Welcome to the part of investing where the excitement is tax efficient and well documented.
Wait, so how do I actually buy into this one?
Look for the ticker SPGI. It trades on the NYSE. You can buy it through any brokerage. It's not cheap, about 29 times earnings. But when you want something that lasts, premium quality usually isn't on sale.
Okay, so what's the growthier one? I'm not gonna lie, this dividend thing is still weirdly slow for me, though I'm curious.
Broadcom, absolute juggernaut in the tech space. They've gone from $6 billion in revenue to over $50 billion in the last decade. But what makes them especially powerful right now is their role in the AI arms race.
So they're not just another chip company?
Not even close. They're like the nerdy kid in high school who quietly ends up running 5 startups and still has time to hit the gym. Broadcom supplies high-performance custom silicon to the biggest players: Google, Meta, Amazon, even Apple. These aren't off-the-shelf chips. They're optimized for AI workloads, hyperscale data centers, networking, you name it.
That's wild. So their chips are basically the brains behind the cloud.
Right. If the cloud had a nervous system, Broadcom would be the spine. And just to flex even harder, they recently acquired VMware. So now they're in software too. Full stack beast mode.
Okay, you're winning me over a bit. It's still not my usual 10x rocket, but at least it's not sleepy.
Far from it. Even though the dividend yield is only about 0.95%, the 5-year dividend growth rate is still over 14%. And they've raised dividends for 13 straight years. It's one of the rare tech stocks that pays you to hold it.
Is it expensive right now?
It's trading at a Forward PE of about 29. So yeah, not bargain bin. But with their position in AI and enterprise infrastructure, I think it's worth it.
So this one's like a stealth AI landlord.
A landlord who also builds the building, rents out the servers, and sells you the power cords. Yeah, that's Broadcom.
All right, we got finance, we got tech. Hit me with something boring. I'm guessing this one's a REIT, right? Those always sound like the real estate version of watching paint dry.
That would be Prologis. But it's not just real estate, it's infrastructure. On the surface, it's warehouses. But behind the scenes, they're the backbone of e-commerce and increasingly AI infrastructure.
Wait, they're in AI too?
Indirectly. They're not building chips, but they are providing the physical space for the data centers that power the AI boom. Think of them as the landlord to the digital economy. Their tenants include Amazon, FedEx, Home Depot, and now they're zoning for hyperscale cloud infrastructure.
So it's not just stacks of cardboard boxes and forklifts. They're actually enabling the next wave of tech.
Exactly. They own nearly 1.2 billion square feet across 4 continents and manage close to $200 billion in assets, including through joint ventures. Their lease strategy includes inflation-linked contracts and high renewal rates, which keeps the cash flow smooth.
Okay, fine, talk dividends. But don't expect me to get excited unless it comes with growth too.
Then you'll like this. About a 3.8% yield, around 13% average dividend growth in recent years, and 12 years of consecutive hikes. It's one of the rare REITs that offers both income and appreciation potential. And they're expanding into cold storage, EV fleet charging, and automated logistics.
All right, that's more future-facing than I expected. Still not my style, but I get the appeal.
When it dips below $100, I treat it like Black Friday at Costco.
So this one's like the landlord of everything the future economy runs on.
Let me guess, you bulk buy your investments too?
Only when there's a coupon code and a free tote bag.
And you get paid rent every single quarter.
I gotta admit, this is convincing. But aren't there a ton of dividend ETFs out there? Like SCHD? Wouldn't it be easier to just buy that and not worry about picking individual companies?
Totally fair question. SCHD is one of the strongest dividend ETFs out there. But here's the thing. Every ETF has its own strategy. SCHD, for example, screens for quality and yield, but it rebalances quarterly, which can kick out great companies just because of short-term screens.
So it's not just set it and forget it?
Not exactly. Plus, ETFs like VYM, DVY, or JEPI all have different sector exposures, volatility, and payout styles. Some lean value, others lean yield. And not all dividend ETFs grow their dividends as consistently as the individual stocks we just talked about.
Huh. I just figured ETFs were the easy path.
They can be. But if you're looking to shape your income stream a certain way, or tilt for growth, consistency, or tax strategy, then handpicking a few cornerstones gives you flexibility.
Okay, so SCHD for simplicity? Individual picks if I want more control or upside?
Exactly. That's why I use both. SCHD gives me a foundation, and picks like S&P Global or Broadcom add torque.
Got it. But now I feel like I need a decoder ring to figure out what these ETFs are actually made of.
Don't worry. I'll get you a laminated ETF bingo card next time. And yeah, you're not wrong. That's why I'm doing a follow-up deep dive. How SCHD really works, how JEPI compares, what VYM actually holds. It'll be the decoder ring you just asked for. Stay tuned.
So, what you're saying is, find companies with durable cash flow, reinvest the dividends, and stop obsessing over headlines.
That's it. The earlier you start, the harder that snowball rolls. These 3 stocks, they're not hype plays. They're foundations. Just like a good roof, you want them to last through every kind of weather.
All right, I get it now. Maybe dividends aren't just for old people in cardigans. It's a mindset.
Exactly. It's about building with patience. You're not chasing overnight wins. You're compounding steady gains year after year. It's slow and kind of beautiful.
I'll take slow and beautiful over fast and stressful any day. Well, maybe most days.
Then welcome to the club. And hey, next time, we'll pop the hood and really look at how these dividend ETFs are built.